Welcome to the Jonathan Van Bilsen Show, featuring lively, in-depth conversation with compelling guests from our community. And here is our host, Jonathan Van Bilsen.
Hello and welcome. Just before we get started, I wanted to point out that during these trying times, we are socially distanced. Our guest today is Michael Connon, a senior financial planning advisor and co-branch manager for the McClellan Financial Group of Asante Capital Management. We're going to be discussing questions and concerns you may have about planning for your retirement, money management during these challenging times, and the proactive measures you can take to help ensure your financial security. Please welcome our guest, Michael Connon. Mike, how are you?
Excellent. How are you doing, John?
Very well, thank you. Before we begin discussing the practical aspects of retirement planning, money management, your 10,000-day project, which was very intriguing, I wanted to talk a little bit about your firm, but also about you. How does the little Irish boy from New Jersey come into Canada and end up in the financial business?
It's a funny story, actually. When my dad was an Irish immigrant, and when he came over, he traveled between U.S. and Canada, but he worked a lot in fixing up houses and doing things like that. His trade was a church decorator, believe it or not, and there wasn't that big of a need for church decorators once he got over here. So when I was my young teens, he bought a house, and his goal was to buy the house, sell it, and fix it up. He was very open about his finances and what he was doing. I guess that got the free labor out of me, so he wanted me to do a lot of the work along the way. When he did, he bought the house for $40,000. This was back in the 80s. And about a year and a half later, he sold it for $80,000.
Wow.
Which was amazing. It was a lot of money back then.
It was a lot of money.
But again, this was during the 80s, and he also had a little bit of an interest in finance, too. So if you remember what the interest rates were back in the 80s.
Oh, I do. I do.
Most people do. He took back the mortgage on the house. And because they don't think the banks would take it, he was over 20% mortgage he was taking back.
Wow.
And with that, he sort of explained to me how this worked. He said, I paid $40,000 for this house. I sold it for $80,000. I'm getting a 20% mortgage. Between 2 and 3 years, I already have my money back. Everything after that is gravy. And that left an imprint in my mind that said, that was a lot of work fixing up that house. Getting 20% return is a lot easier way to go about life. So right. I found an interest in finance after that.
And you came to, was this in New York, in New Jersey?
This was back in New Jersey, yeah.
Okay, so then your family moved to Canada?
Moved to Canada. I was actually born in Canada,
okay.
And I always wanted to move back. I had my brother and some family were here, and I always pushed to return back to my homeland.
Right.
And it was a great decision. I moved to Canada and have loved being in Canada ever since.
And you went to Western University?
Went to Western, got a degree in applied mathematics, so I'm a math major.
Okay.
And graduated in the early 90s. And again, if you remember that time, it was a very recessionary time.
Right.
Housing market just dropped. When I finished university, there were no jobs available. So
right.
I did what every smart university grad would do. I got a job working in a bar.
She's an Irishman working in a bar. That's a novelty.
It seemed like the obvious choice. When I worked in there, I learned a lot about business.
Mm-hmm.
And at the time, it was a lot of bars were going bankrupt, and I got put in managing a bar through a bankruptcy. And
okay.
It was interesting. At the time, I went through and I worked with all the landlords. I worked with all the banks and did this at a very young age.
Right.
And the day it was going bankrupt, I went to one of the regulars who owned a financial firm, and I told him not to come in the next day because I was putting it through a bankruptcy. And he said, did you do all this yourself? I said, yeah, I've been working on it, so that's been what I've been doing. He handed me his card. He said, come see me the next day.
Really?
So next day he hired me, and that's where I got my start in finance.
Wow. Now, is that the firm that you're with now?
No, I changed firms, actually.
Okay.
Interesting story. Back when I was working at the bar, there was another person working with me, Rob McClellan,
mm-hmm.
and he was doing it as he started his financial business.
Okay.
And a couple years later, after I got started, he came and asked me to join him. He needed some help, and we joined up, later became partners, and we've been partners for 25 years or so now.
I was going to say, it's been over 25 years. Right?
Yeah.
So I guess it's a standard that if you're going to go into financial business, you have to be a bartender first.
Yeah.
And now you're working for an award-winning company. You're the senior financial planning advisor and co-branch manager of the McClellan Financial Group. So give us a little bit of overview of your company. You've won some wonderful awards.
Yep.
Why don't you just elaborate a little bit on that?
We won. I hate going through awards. Let me think. What do we got?
Let me see. What I've got here is you won the Wealth Professional Loyalty and Client Care Award.
Yeah.
You won the top 50 advisors 6 years in a row, and this year you're nominated for you're number 3 this year, nominated for Advisor of the Year.
Yep.
Which is very, very commendable. The Advisory Team of the Year, and the Digital Innovator of the Year.
Yep.
Because I understand that in the investment business, there's a lot of paper, right?
Yep.
And to move away from that is not an easy challenge, I imagine.
It's been a big piece of what we've been trying to move. You know, it's funny as we go through all these crises. A lot of things we did 2 or 3 years ago, or even 5 or 7 years ago,
right,
are really coming to be very important right now.
Of course. So because this is not an infomercial for you and your firm, I wanted to kind of pick your brain a little bit and ask what a good financial advisor should be doing for their clients.
A good financial advisor doesn't only look after the money, they look after the client's financial lives. And, you know, we always think a financial advisor's got to pick a stock for me or pick a bond or do something like that. That's really a small portion of what a financial advisor's job is. A big piece of what they have to do is take care of the client's retirement. If they haven't retired yet, they have to get them prepared to retirement. They should be asking their financial advisor when it's okay to retire.
Right.
You know, you have conversations. Some people want to work to 70. Some people want to retire at, you know, 50, 55. Right. And to plan that, to make sure it works for them. They have to work with estate planning to make sure that your older clients and even your younger clients, in case anything happens, they're taking care of everything that's passed off in the same way. They have to work on taxes to make sure taxes and finances are two things that are together. You know, 20 years ago, there used to be two separate people that never talked. There was the tax preparer, the accountant, there was the financial advisor picks and stocks. They still need the accountants, but they need these people to work together. So it's really quarterbacking people's entire financial lives.
Which is, it's extremely important. I mean, I was ready to retire at 35, other than the financial element.
Yeah.
So I'm still working. But so your firm also offers tax planning and doing the tax returns as well, right?
Yeah. People really want, you know, this has been really created by demand. We had a lot of clients that didn't want to go different places. They just want to come and see one person. As you retire, your goal is to continue to simplify your life.
Right.
And the more simple it can become, less people you have to have involved, the easier it is.
There's a lot to be said for one-stop shopping, especially when it comes to finances, because, I mean, your taxes are based on the amount of money that you have, so it only makes sense for the two to be married together. I always find it interesting that it's not just the amount of money you make in your investment, it's also the amount of money you can save on taxes. Like, it's an overall encompassing goal that you're trying to achieve.
Yeah, my dad used to always have this one saying. He says, making money is easy. It's not what you make, it's what you keep at the end of the day. And he said it's easy to make money. So, yeah, it's a matter of taking care of everything. And, I mean, some people more complicated tax situations, and you work with their accountant rather than do their tax returns. But everyone's situation is very individual.
I remember back in the day when my very first RSP policy came out when I think I was about 21, and RSP had just come out, and it was my insurance guy that actually sold the whole thing to me. He was the one who was behind it all.
Yeah.
So I guess that's changed a lot. I mean, insurance people are still in the financial business, but
yeah, they've sort of. We have to understand insurance. Insurance have to understand ourselves. So we have a more symbiotic relationship now between us and the insurance companies.
Which is important because it does all tie together. Wills, estate, the whole gamut.
Yeah,
it's very important. So I was reading, and we were chatting a little bit about your 10,000 day project that you're just sort of launching, and which I thought was very interesting. I wonder if you could just expand on that a little bit.
Well, 10,000 days. The concept is that if you retire in your 60s and you live till your 90s or close to your 90s, you're going to have about 10,000 days in retirement.
Right.
That's a lot of days.
That is.
Right? And people have this idea that retirement is just stop working. There's a lot more to retirement than just not working the next day.
Right, it's a redirection, basically, right?
It's a phase. It's like saying when you worked, it was just you took a job rather than go to school.
Right.
It was a whole different phase in life when you went from being in school to going to your work life.
Right.
When you go into your retirement phase, there's a lot of different components to it.
Okay.
And what we've tried to do is we've tried to put together these components in something people can understand.
Right.
And you know, we looked at things that were important in people when they retired. Travel is a big thing. I know you're big in the travel industry, and travel is a huge thing. And we tried to make it so people can understand what trips they should go on, when they should go on.
Right. Well, that's very important. Obviously, you don't want to be going to climb Mount Kilimanjaro when you're 87 and then go to New York City when you're 65. Like, to reverse those sort of things would be important, right?
You know, you have these plans. You plan for all this different stuff in life. When you hit your retirement, you should probably put a travel plan together.
Right.
You know, say what you want to do and when you want to do it.
So your firm is sort of starting this new project, this new business, which helps people through different facets of retirement.
Through different facets. I mean, there's travel, there's the psychology of retirement, which is a huge piece too. A lot of people lose their purpose in life when they hit retirement. So you have to go and find out what's going to be important to them. Again, it's just not stop working. It's having something that's your next phase of life that makes it meaningful.
And I'm sure there's also the element that not every spouse retires at the same time. Like if you have a spouse that's a few years younger, you may want to retire and your spouse may decide to keep working, or vice versa. Yeah. And I'm sure that has its own features as well.
Oh, absolutely. I mean, as there's a lot of couple therapy that comes with retirement.
Hence the psychology, right?
So there's a lot of pieces like that. And then there's the obvious financial ones as far as estate planning, making sure all things are set up that way. There's the finances behind the retirement. There's pension plan arrangements and all. So there's a lot of different facets of retirement beyond just the financial aspect.
I wanted to touch quickly, we've got a few minutes before the break, on the 4% rule. I understand that when you retire, your investment portfolio should net you no more than 4%. Is that?
The 4% rule, it's been a rule of thumb in the finance industry for years. It's come under a bit of scrutiny now because some people expect rates to be a little bit less going forward. So some people question the 4% rule, but it still is a good starting rule. And what it means is, if you have, you can take 4% of your investment portfolio safely when you retire and continue to take that throughout your life. And so...
And we're talking about retirement at 65.
Retirement at age 65. So if you look at that, and let's assume you have $1 million. So that means you have $40,000 a year you can draw out pretty safely up until you pass away without any problems in there. Again, you have pensions on top of that. So if you think of a family with CPP and OAS, and they have, full CPP and OAS for two spouses, you're probably going to have between $30,000 or $40,000 worth of government pensions on top of that. So someone could actually have a retirement income of, $70,000, $80,000. Depending on how the investment's done, there may be taxes on that too.
Which sounds like a lot of money, but I remember my parents were in a retirement home, and I think their cost was about $5,000 a month for the two of them, which is $60,000 a year, which is about $80,000 pre-tax. So consequently, that's something to think about.
Yeah, you need a lot of money.
Absolutely.
It's surprising.
The people are very concerned about their finances, the best at times. We're going to take a break. When we come back, we're going to talk some more with Mike and a little bit more about some of the things that you will have as concerns in your financial portfolio. We'll be back in a few minutes. I'm Jonathan Van Bilsen, and I've had the opportunity to spend my life traveling and photographing exotic locales around the world. Thanks to Rogers TV, I'm now able to share my adventures with you on my show, Photos and Travel, right here on Rogers TV. Welcome back. Our guest today is Michael Connon. He's the Senior Financial Planning Advisor and Co-Branch Manager for the McClellan Financial Group. Mike, before the break, we talked a little bit about some of the current challenges that people are facing in this day and age of, I guess, just a time that has never been tried before, this sort of thing. I remember in 1981, it was a little tough. 92 rather, wasn't a whole lot better. 2001, there was quite a recession, and then of course 2008, a major recession. Here we are in 2020. So can you give us a little bit of perspective on the recessionary concept, the market changes, and how worried should people be about this?
Well, there's that great saying that said, this time it's different, right? And the reality is every time it's different. So there's a similarity between all these different time periods we go through. But some similarities we got to remember is the markets always do recover. They always have.
Right.
And you know, we're going through right now this COVID crisis, and it's a major situation. We've never seen anything like this, where there's this type of unemployment brought on us at this speed. So it is a severe situation, but again, the market still works, because there are still people have to eat, people still have to drive cars, people still have to go to the gas station, people still have to buy clothing.
Right.
So there's still that necessity for companies to survive. And there'll be companies that do well. You know, there'll be drug companies, there'll be other companies. Some of the food supply companies, are the supermarkets are doing well. Right. You know, even at times, a lot of people have been putting money into their houses. So right. People have been doing good on renovating houses and business in that area. So there's positives in this.
Also, companies like Amazon, I'm sure, are not hurting too much.
Yeah, they're doing fantastic. So. With all these financial crises that we go through, there's always a light at the end of the tunnel.
Right.
And the key is not to panic. And our job as financial advisors is to make sure people don't make mistakes.
Right. So what sort of mistakes would people make? Like my immediate thought is, oh my gosh, my money is gone, or I'm losing a lot of it. Am I ever going to get it back? Maybe I should sell, which I know is probably not a good idea.
That's a big mistake that people generally make. People make, number one, is just to get out of the markets.
Right.
People also make mistakes where, you know, they'll run to one asset group. You know, gold has been this one safe haven where people will say, no, I don't. I'm worried about everything. I want to have everything in gold.
Right.
And they'll take too much risk, and no one knows the future. You know, as we get into, when you start doing this business, you think you know everything. As you get further on, you realize you don't know that much about. You know, this COVID thing has been a surprise to all of us in the financial world.
Right.
When we're recording this, the markets have went through a big down period, but had a recovery after that. None of us expected to be that quick.
I know the recovery is phenomenal. I'm not sure what the numbers are, but I know that it's the fastest recovery in a long time.
Yeah, it's surprising. It has us all a bit shocked, because the unemployment numbers and everything out there don't dictate the market returns right now. But, you know, things happen.
They do. I guess the concern is that because it's such a rapid increase back into the portfolio, into the markets, is it going to stay? Is it going to fall down again? Is it going to, because the markets traditionally tend to be a 6-month projection of what's going to happen, correct?
Yeah, the markets are the lead indicator, and that's
Right.
the tricky part. Everyone thinks there's some indicator that's going to tell you what's going to happen in the markets. The reality is the markets are the lead indicator to what's going to happen in the world.
Okay.
So the reality is, your best bet is not to try to adjust your portfolio around the current conditions, because it's already built into the price of the portfolio.
Right.
They already know what's happened. You know,
Right.
The markets know COVID's here.
Yep.
So they know that. So
Yep.
there's no use on trying to make extra adjustments to that. The markets have taken that into account.
Right.
For most people, if you have a long-term strategy, you shouldn't be making all these adjustments to your long-term strategy. I know we're going to get through this, and I know there's going to be another disaster in the next 10 years that's going to have an effect on the market too.
Right.
I can't tell you what it's going to be, but I know it will happen.
Right, right. I guess it must be very frustrating when people who don't know anything about financial business come to you and say, well, I want to change my stocks, I want to invest in Dollarama or in Zoom, sort of thing. And I looked at Zoom myself, because as soon as I heard how wonderful that company was, it was way too late.
Yeah. The market is very efficient. The market figures things out. And, you know, you got to remember, you're not the only one in the marketplace. This is what everyone gets confused at. Everyone else has figured this out, too.
Right.
So when you see these stocks going through the roof, yeah, the world gets news very quick, and the world as a whole is very smart.
Right.
Individually, it can be pretty stupid at different pieces, but as a whole, they make very good decisions on where things belong.
Yeah, so I guess the message is leave it to the professionals. Like and it's like anything. When my car breaks down, I don't try and fix it myself. If I'm sick, I go to see a doctor. If I have financial concerns, I should go and see a financial planner. I guess that's a given. We're very fortunate in Canada. I believe we're very fortunate in Canada. Not only are we managing the curve better than a lot of countries, but the government stepped in fairly quickly, I believe. And I'm assuming that's a positive thing.
Yeah, you won't hear me giving a ton of compliments to the government that often, but I got to say, this time, with everything they've done, given the situation, They made it so people had access to money very quickly.
Right.
They've made it so there's not that many foreclosures. There hasn't been as many bankruptcies as we've expected.
Right.
They have rules for landlords and everything in place. So they've managed this immediate concern very well. I don't know how it works out in the long term with the tax ramifications,
right.
but I mean in the short term, they did a good job.
Well, the consumer confidence, I'm sure, is quite high now.
Yeah, and
I don't know why they continue to apologize for everything they do, but
yeah. Well, you watch other countries and you watch the problems in the U.S. and what they went through, and you see the spread in Canada has been at this time anyway. It's still a problem,
right?
But it's been better than a lot of other countries in the world.
Right. So it's the better of the evils. I know uncertainty lies ahead. Like nobody, as I say, nobody really knows what's going to happen. But there are practical measures, or there should be some practical measures to develop a little bit of stability. Is that right? That you can create yourself?
Yeah, absolutely. I mean, when you design a portfolio, you need to not only think about all the good times, you need protection for the bad times.
Right.
We talk about having bonds in a portfolio and fixed income. It doesn't pay much now. And honestly, it's not going to pay much in the near future.
Right.
Interest rates are very low, but it's not about just trying to make money. It's about having stability in your portfolio to support you through these bad times, to have a rebalancing strategy, something like that in your portfolio to get you through rough times in the marketplace.
So I'm thinking people who have a large mortgage. So let's say, for example, you've got an $800,000 mortgage on a $900,000 house, if that's possible.
Yep.
Mortgage rates are pretty low.
Yep.
The chances of them going up are probably good because they can't really get much lower.
Yep.
What sort of precautions should people take going forward? Should they spend a lot of money? Should they not spend money? Should they get 3 jobs, sell their houses?
Being conservative is the best thing that people can do. I mean, if you're conservative on your spending, again, one thing we've noticed over years of doing this is how successful people are is not based on what they make, it's based on their spending habits.
Right.
And I've seen people that make hundreds of $1,000s a year and spend everything.
Right.
And there is nothing left. I've seen people that, families that have lived on $60,000 a year and have put 3 kids through university, have their house and mortgage paid for, all done, and it's all about their spending.
Well, I know during the entire pandemic, spending has been very, very easy. I found I used my phone to pay for things. When the mask concept came into being, I started using my Apple Watch to pay for things. It's just so easy to buy things.
Yeah, sometimes these market corrections are a bit of lesson humility, where people don't get extravagant because it starts getting pushed too far.
Right.
And again, spending's okay when you have the money.
Right.
People that are borrowing to spend and, a line of credits on houses, that's just a bad idea.
I assume that the best strategy is to pay down your debt before you start to invest.
Yeah.
If you have a mortgage, get rid of it as fast as you can.
Yeah, I mean, you want to do your RSPs and your tax-free savings accounts and RESPs and all that stuff. But, I mean, at the end of the day, I haven't seen very many people in a financial problem that have their house paid off with no mortgage.
Right.
They don't have the financial problems of other people with high debt.
And that's always been drummed into me when I was a kid. Like, always make sure you get rid of your mortgage. So some of the questions that clients are coming to you with at this, excuse me, at this stage in the economy, what sort of questions are you getting from people?
Oh, just the biggest one is when is this going to end? I mean,
I'm sorry. And the answer is.
And the answer is, I'd love to be able to. People are always looking for a quick answer and quick solutions. It's really. Investing is a game of patience,
right?
And I know they have the average. It's not a game,
Yeah.
So I guess it is not a game, but it really good investing takes patience.
Yeah. Well, I know you're in it for the long haul, but when you get to my age, the long haul is much shorter.
Yeah.
So that's a concern. Do people want to contact their financial advisor, or are people saying, I don't want to know, I'd rather not know?
People have been pretty good on contacts. I find as time goes on, investors gain experience, and they understand this is part of being an investor over the long term. You're going to have ups, you're going to have downs, you're going to have time where the market seems really too good to be true, and you're going to have times where you think this will never get better.
Right. It must be tough on the young investors. I mean, they don't know anything else, right? This is all they know.
It's tricky because young investors tend to be told to be aggressive, but they don't know how to deal with it.
Right.
So they tend to make the bad moves. Luckily, they make the bad moves early when they don't have a lot of money.
Right. Yeah. Yeah, I mean, I wish somebody had these conversations with me when I was 20 years old rather than at this stage,
Yep.
you know, because then I could have retired at 35. I'm curious the difference between equity and fixed income and rebalancing portfolios, which is something that people should be doing all the time through their investment people, of course. But what exactly is the difference?
Well, the difference is equities are stocks, so they're companies. Okay. You own companies, and you're going to go up and down with that company. So the company does well, there'll be profits, you get dividends off them. It tends to be the growth part of your portfolio.
Right.
A fixed income or bonds are the debt of the companies. Okay. And they'll generally have more of a guaranteed structure or nature to them.
Right.
They'll still have some fluctuations in them, but they're going to be much more secure than equities. But again, with security, risk and return are always related. So that security is going to mean much lower returns.
Right.
So for someone to have a portfolio, they're going to want equities for growth, fixed income for security.
Okay.
And there's a balance that everyone has between those two that's going to be different for everyone. It's going to be different for a 20-year-old. It's going to be different for a 70-year-old.
Okay. And that's something that your firm sort of, or a financial firm would have a model that works for everybody.
A model that works, and it's based on personality too.
Right.
You know, some people don't mind risk. I have 70-year-olds that could care less about risk. They don't lose a minute of sleep at night over what's going on in their portfolio.
Right.
Other people, I have 30-year-olds who are scared to death if the portfolio goes down by 1%. So it's not just a factor of age, it's a factor of people's personality too.
Right. Well, I know people who constantly look at the markets on a daily basis, an hourly basis. I have it on my phone. I push the button. It's either green or it's red.
Yep.
When it's red, I panic. I don't know what to do. So I just turn it off, and I find that to be the best solution. Now, I assume you're meeting with your clients on a regular basis, either by telephone, Zoom, or whatever the case might be during this crisis to keep everybody happy.
You know, we've tried to keep everything exactly the same as before, and even try to up the amount of meetings a little bit more to be, the key is contact.
Right.
And I've tried not to change any of our business because of the obviously we have to change, we have to work from home, but you try to make it sure so everyone's experience still stays the same.
Excellent. Well, this has been very, very insightful, Mike. Very appreciative of everything that you've said. I feel reassured. I can take my coffee break today and not have to worry about that. Your contact information we're going to put on the screen in case people want to have a call with you or something, or ask you some more questions. That would be great.
Perfect.
I'd like to thank you all for joining us today, and we'll look forward to seeing you next month.